Thank you for joining us for the tax increases on the horizon, a first look at reconciliation recommendations. I'm Diane Boyle, NAPA's Senior Vice President of Government Relations. I'm joined by Tim Hanford. In a prior life, Tim was, I guess he spent over a dozen years staffing the Ways and Means Committee. So he comes to us with an insider's perspective, and he serves as our outside counsel. So we're happy to have him join us today. We're going to go through a little bit of this. Now, remember, the committee markup is only one step of many. But today, what we're going to try to do in our brief 30 minutes is really provide some good visibility into the specific provisions, which will become far less transparent as the process turns to leadership negotiations. They become a little more tight with what they're talking about, and we won't have the details that we actually have now to share with you. As you know, the Democrats are proposing a $3.5 trillion spending package with roughly $2 trillion in tax increases. We'll provide a high-level explanation of the proposals and how they would impact different categories. Your business, how it would impact some of your business clients. We'll talk about the impact on retirement and estate planning. We'll cover employee benefit offerings and healthcare financing. And then we'll wrap up and we'll talk about what some of the next steps might be. Please remember, the reconciliation package is much larger than what we'll cover today. 13 committees in the House have already weighed in, and by no means are any of these provisions final. Tim, let's talk a little bit about tax now. Can you cover some of what the business implications might be to our members and certainly their clients that are going to be impacted or running businesses as well?
Sure. I'll cover some of the high points from the 900-page tax bill. First thing to know is that the proposal would increase the top individual tax rate from 37% to 39.6%. That comes right out of President Biden's proposals. The new top rate would apply to joint filers with incomes over $450,000 and individuals with incomes over $400,000. So there's quite a bit of a marriage penalty built into that proposal. And that would kick in starting next year. There'd also be an increase in the top corporate tax rate. Currently, the top rate is 21%, and the Ways and Means proposal would take it up to 26.5% starting next year, which isn't as bad as what President Biden had proposed. He wanted to go to 28%, and Senator Manchin of West Virginia said that 25% is the top rate that he'll accept. The Ways and Means proposal also has lower corporate rates for corporations with incomes under certain thresholds, so not everybody will be subject to the top 26.5% rate if it goes through. There's also a proposed increase in the capital gains tax rate. The top rate would go to 25% under the Ways and Means bill. Interesting effective date on that, it would generally apply to gains recognized after September 13th of this year, the date the committee put out its proposal. There's a transition rule for gains recognized pursuant to a binding written contract entered into on or before the 13th. But generally, they wanted to make the rule effective as soon as it was announced because they were afraid that people would start to sell assets during the remainder of this year to get the current lower rate if they waited to make it effective. What the Ways and Means Committee did is certainly not as bad as what President Biden had proposed or as what the Finance Committee is rumored to be looking at. President Biden wanted to eliminate the step up in basis at death that we now have, and he also wants to impose a capital gains tax at death. Senator Wyden is interested in that proposal. It's getting a lot of pushback from farm state members and from small business interests. House Ways and Means Chairman Richard Neal said that he'd love to have looked at that proposal, but when he did the math, the arithmetic said there weren't 218 votes in the House to adopt it. There's a change proposed to the net investment income tax. Right now, a lot of businesses are formed as S corporations, and they pay the 3.8% net investment income tax only on the salaries that they pay out, but not on the rest of the business income. The Ways and Means proposal would say that all of the business income is subject to that 3.8% tax. So that's quite a change for some small businesses.
Yeah, I think there are a lot of changes for some of the small businesses. And I think important to note when we get into some of the retirement provisions too, we'll talk about that marriage penalty that you mentioned. We're seeing individual, threshold at 400, but the joint is at 450. That doesn't give a whole lot of wiggle room between being single and being married. But I'll stop and let you finish the rest of some of the business hits.
Well, we married people have to complain about marriage penalties wherever.
Right.
Although I did get in trouble once when I said in a speech that the marriage penalty has nothing to do with taxes. There's a proposal for a 3% surtax on individuals with incomes over $5 million. I don't know if that applies to a lot of the people attending this webinar. If it does, congratulations. There's a change to the small business, the pass-through business deduction under section 199A. They're proposing to cap that deduction at $500,000 for joint filers, and I guess $10,000 for trusts. Diane, I think you wanted to talk a little bit about some of the implications of that.
Yeah, I think our listeners will recall that in the 2017 tax reform, there was a provision that provided a 20% deduction, 20% qualified business deduction for pass-through business, but financial advisors were excluded. So a number of our members aren't able to take advantage of that now. Senator Wyden has a proposal that actually would allow financial advisors to be eligible. We'd still have some type of cap. The House version did not do that. So the House version, and it was funny, Tim and I, along with a number of the other government relations team members, have a Monday morning call. And as we were going through the different provisions, as Tim said, there are over 800 pages just on the tax provisions alone. We're digging through frantically to say, wait a minute, did the House actually eliminate that exclusion for financial advisors? And, for real fun, if you want to go back, Judy has flagged the page number for us, and it was page 650. So we can send over the full 800 pages and you guys can dig through that. But we are watching, and as we mentioned at the beginning of the call, it's still very fluid. We still have to find compromise or common ground with the Senate. And the Senate provisions on a number of these things have a slightly different bent. So we have a good idea of what's being discussed, but the details are very much subject to change. Tim, I don't know if you have anything else in sort of the business side.
Well, there was just one more business provision we talked about, and that is back in 2017, when they changed the law, they put in a temporary provision that would limit your business loss deduction to the amount of your business income. And the bill in front of Ways and Means this week would make that rule permanent.
Right. Well, we'll shift a little bit and we'll jump back to Tim in a minute to talk about some of those state planning implications too. But before we do that, there was a lot in the retirement space. There's a new plan and there are a lot of changes that go through. So I'm going to run through some of those. There's a new auto enroll, auto escalate plan. And what that does is it requires employers with more than 5 workers to offer a retirement savings vehicle. It's mandatory for employers, but employees have an option to opt out, and they can also change their contribution. The penalty for this, if employers fail to provide a retirement option, such as a 401k or an individual retirement account, it would cost the business an excise tax liability of $10 for every worker per day of non-compliance. There's a pretty stiff penalty there for not complying. There were also, as I said, a number of changes. One of the changes was to mega IRAs and to those rules. And what it would do is it would prevent further contributions once the IRA account levels exceed $10 million. This applies to single taxpayers, again, making $400,000 or more, and joint filers making over $450,000. So if you're hoping to become wealthy, you don't want to get married. It also adds a new annual reporting requirement for employer-sponsored defined contribution plans with aggregate account balances of more than $2.5 million. There's also forced distributions. So it increases the RMD for IRAs, Roth IRAs, and defined contribution plans with balances exceeding 10 million to 50% if the account balance exceeds $10 million. If the combination of an individual's IRAs, their defined contribution plans exceeds 20 million, the required minimum distribution is the lesser of the amount needed to bring that aggregate to 20 million across all accounts, or the aggregate balance in the Roth accounts. It also eliminates Roth conversions for individuals with income over $400,000 or $450,000 for married couples. It prohibits all employee after-tax contributions in qualified plans and after-tax IRA contributions from Roth conversions. It prohibits an IRA from holding a security if the issuer of the security requires the IRA owner to have a minimum level of asset or income. Also prohibits an IRA owner from owning among individual family members and the IRA more than 10% of the business, other than a publicly traded company.
Diane, these changes to the mega IRA rules are kind of interesting. They're an example of how tax policy sometimes comes direct from the headlines that we're reading. You may recall there were some leaks of IRS data about individual taxpayers a couple of months back. And one of the things that leaked out was that Peter Thiel was supposed to have an IRA worth $5 billion. All of these proposals stem from that one story.
Can you hear me? I apologize. I tried to take advantage of muting while Max was disagreeing with some of the policy provisions.
How big is Max's IRA?
Yeah, exactly. Apparently he has a heck of a lot more than what I do. It very upsetting. It would also, talking about preventing, we're going to do a FedEx delivery. Perhaps it's one of his distributions coming to fruition. The proposal also prevent an individual from investing in any entity for which he or she is an officer or director, and that's regardless of the percentage of ownership. Tim, I'm going to quiet Max and go ahead and let you talk a little bit about some of the estate planning implications from some of these provisions.
Okay. I guess the good news is that this Ways and Means proposal does a lot less in the estate planning area than some would have done. But what it does do is it gets rid of the temporarily higher estate tax unified credit that was passed in 2017. That higher credit that exempted about $12 million per person was scheduled to expire after 2025. This bill would have it expire after this year. So the unified credit exemption amount would go to about $6 million per person starting next year. Yeah, not insignificant, but still not as good as it had been. There's a proposal to limit the use of grantor trusts. A lot of estate planners had used a technique called the intentionally defective grantor trust, something that treated a trust as owned by the taxpayer for income tax purposes, but owned by someone else for estate and gift tax purposes. This new proposal is kind of complicated, but it would essentially apply the same rules for both income and estate and gift tax purposes, and would eliminate the technique for future trusts. So it doesn't apply to anything that's out there now. It might apply if you modify those trusts, but otherwise it just applies going forward. Another area of estate planning is valuation discounts. And the proposal from the Ways and Means Committee would limit the use of valuation discounts for non-business assets. Some people had put liquid assets, public company stock or whatever into entities, taken minority interests in those entities, or sought volume discounts. This proposal would prohibit those kinds of discounts on traded assets or non-business assets. So again, it would limit a common estate planning technique. I'll stop there.
Great, and so we'll shift to what I call the really messy section of what's going on too, and that's to talk a little bit about employee benefits and Medicare, Medicaid, ACA changes that came about. There's a new paid leave program. The program would provide a government paid benefit for up to 12 weeks of leave under the Family and Medical Leave Act. And when this is fully operational, the benefit, which is scaled to income, would pay a weekly benefit somewhere between 85% and 5% of wage replacement. The benefits are based on the number of uncompensated caregiver hours that a person delivers, and they're available only after exhausting an employer-provided paid leave. There's also a process within this new program that would allow employers who currently provide paid leave to be reimbursed by applying for a federal government grant, and that would cover 90% of the employer's costs for providing that paid leave. There's also an application fee for the employer in order to apply for the grant, and that's a $1,000 fee to apply. Then we get to the sort of the Medicare, Medicaid, ACA changes, and that is just a mess. There's shared jurisdiction over those issues between the Ways and Means Committee and the Energy and Commerce Committee. The committees, I'll first tell you what they've sort of agreed to do, and then we'll talk a little bit about where there were some challenges. The committees would make permanent the ACA premium tax credits. It would expand Medicare Part B benefits to include vision starting in 2022, hearing in 2023, and dental in 2028. And it subsidized health insurance for Medicaid in non-expansion states. They did not lower the Medicare eligibility age. That was something that will probably still be a sticking point when it gets to the Senate too. That's something that I know Senator Sanders is very much interested in doing. The recommendations, even without including that lowering of Medicare eligibility age or expanding, providing a Medicare for all type plan, is still too expensive to fit into the $3.5 trillion package. So at some point, they're going to have to sort through what stays and what goes and how they make it fit within that price range. The mess that I was talking about earlier, aside from just it being too big to fit into the actual $3.5 trillion package, is that in energy and commerce, they actually, 3 of the Democratic members were able to switch their votes to no and did not approve a Medicare provision that addressed a policy regarding prescription drugs. And so it failed in the Energy and Commerce Committee, but because they have shared jurisdiction, it did pass in Ways and Means. So it is being moved forward, but it gives you an indication that those 3 members who were Representative Scott Peters from California, Kirk Schrader from Oregon, and Kathleen Rice from New York, that they might have some concerns. And also, as we talk about that, and I'm going to shift and bring Tim a little bit more into the conversation, Stephanie Murphy on the Ways and Means Committee also voted against the package coming out of committee. So you're starting to see some of the moderate Democrats having some concerns with the process or the package, even in this early stage. And in the House, there's very slim margins. And if you start counting your numbers, if those that objected in committee object on the House floor, is this package going to pass? And Tim, I'd love to get your thoughts on, does the package become more moderate and sweep in these individuals, or are we going to see the package with some of the more progressive Democrats, really wanted a package at $6 trillion, so they feel like they've already had their negotiation And this is as low as they want to go. Are we going to?
I think that we really haven't seen the hardest part of this for the Democrats yet. As you said, Senator Sanders, when he put together his ideas, it would have been a $6 trillion package. But he compromised with other senators, and I put compromise in quotes, and came up with $3.5 trillion. But Senator Manchin and Senator Sinema have said, they think that $3.5 trillion is way too much. Senator Manchin was clear that he would not accept a package of more than $1 to $1.5 trillion. Now, you might ask, why does one senator matter? Well, because in the Senate, it's 50-50. And so if we assume that all of the Republicans are going to vote no on this, they need every Democratic senator vote yes, and then it only passes when Vice President Harris votes with the Democrats. If Senator Manchin says no on the package because it's too big, the package doesn't move forward. That frustrates the progressive Democrats no end, but I don't know that that's going to change Senator Manchin's mind. He went to the White House last night to meet with President Biden, and the fact that we didn't hear anything after that meeting tells me that his mind wasn't changed. So they're still going to have to wrestle with the overall size of the package. A couple of weeks ago, the House moderates negotiated a deal with Speaker Pelosi that she would not bring a package in front of the House that couldn't pass in the Senate, because the House moderate Democrats were very concerned about being asked to vote for something that wouldn't eventually become law, because their votes will be used against them next year during their re-election races. So all of that still needs to be sorted out. The process is a little unclear going forward. Now that the committees have approved things in the House, their recommendations go to the House Budget Committee, which is just supposed to package them together. And then at some point, Speaker Pelosi is going to have to decide what she wants to put in front of her members. We haven't yet seen the Senate proposals, which have to match up with the House proposals eventually for something to become law. There are a couple of open issues that are pretty big. The state and local tax deduction. In 2017, Congress limited that deduction to $10,000. A lot of Democratic members, particularly from the coastal states, think that that's unfair and wrong, and have said they won't vote for a package that doesn't eliminate that limit. The Ways and Means package doesn't include any change to the state and local tax deduction rules, but Ways and Means Chairman Neal and some other members of the committee have said that they're looking at meaningful changes that they will incorporate at some future point. They were kind of vague on that, so we'll have to see what happens. They've suggested that they might use changes to the rules requiring banks to report account information to the IRS to pay for some of those changes to the state and local tax deduction. But it's not an easy issue, even among the Democrats, because there are some Democrats who say that increasing the state and local tax deduction is a gift to the rich, and they would not support that, particularly people like AOC, who was wearing a dress the other night that said, "Tax the rich." So lots of fun.
Yeah, I think that will, and we have new deadlines too. We should talk about those a little bit. So there's the debt limit that's coming about. We have September deadlines with the Surface Transportation Authorization, the National Flood Insurance Program, the temporary assistance for needy families expires, COVID-related paid sick leave expires. How does that dovetail into this whole reconciliation package?
Yeah, that's a really good question. I mean, I expect that
I'm good with the questions, not so good with the answers. I want you to come up with
we're going to see a continuing resolution sometime before the end of this month that will keep government spending going at its prior levels for some short period to let the various committees come up with their appropriations language. And it may end up extending itself a couple of times. The issue is whether you attach an extension of the debt limit to that bill. Republicans in the Senate have said that they will not support an increase in the debt limit, and that it's up to the Democrats, if they want to pass it, to add it to their reconciliation bill that they plan to pass on their own. I don't know whether that position will stay. Perhaps Republicans would accept a short-term extension of the debt limit if attached to a short-term extension of spending, but we haven't seen anything yet. So we know confrontation is coming. If the Republicans do defeat the continuing resolution for spending because of the debt limit being added to it, then we might have another government shutdown. And we've seen those before. And the only bad news about a government shutdown is that Congress doesn't stop working when there's a government shutdown.
Yeah, that is the bad news. We don't get a break from that. What, you tipped your hand a little bit on timing. How quickly do you think this gets done? Is this moving fast, or do you think we're going to slow down a bit?
Well,
and are we expecting to work through pull through December until the end of the year to get these things done?
You know, I don't know for sure, but I would suggest that you shouldn't make any Christmas plans. It could well be going until December 24th. Congress always makes the hard decisions at the very last minute. There's no absolute limit on when they have to pass these reconciliation provisions. Democrats perceive a practical limit that if they don't get it done this year, that next year being an election year will make it harder to do it. And the longer these proposals stay out there, the harder it gets to sell them. So I think it has to get done this year, but there's no real deadline, unlike the government funding, which runs out on September 30th. So it's a real deadline. And the debt limit, that runs out.
Right, so we'll have to see those addressed in some manner. We're getting close to our time. I want to close out with just one little bit of information and get your feedback on it too, Tim. You know, we've had strategic engagement with our members. We've tapped a number of you who are probably on the phone listening to meet with key members of Congress on different provisions. Some have asked, well, you know, why haven't we been asked to contact our member on a given provision? Can you talk a little bit, Tim, about the process when we get into reconciliation? I think it changes a little bit, where very often we'll come out with a massive grassroots push, but the Republicans, especially for our members in Republican districts, may think, why aren't I being asked to do anything? Can you tip your hand a little bit as to why we're not engaging them at this point?
Well, I think for the Republicans, they know what their position is on this bill. They are all going to be voting no. So they're less interested in trying to perfect the bill, trying to tweak various provisions in it to make the provisions work better when they're not interested in having the bill pass. So it's a tough sell for them. Is that what you were hinting at, Diane?
That's exactly it. It's where, you know, and we will continue. Some of our members will be asked to make strategic outreach to members of Congress. But by and large, those of you in Republican districts won't be asked because there isn't a need for you to weigh in with them. And this isn't something that's played out, as we hinted to earlier. The committee process, the markup, was where we were actually seeing detail. The next steps in the process are probably going to be held a lot closer to the vest with leadership making decisions. But we are very much still engaged. As Tim noted, he and I will both probably still be working really hard, really long hours through December 24th. And we'll keep you posted as things move. We wanted to jump on and give you a quick down and dirty as to where we are now, and we'll follow up with you soon. There's also a September Gov talk that everyone should have received that'll go through these different provisions with a little more detail in writing so that you have something to go back and reference. With that, I thank you, Tim, very much for joining me today. Max has stated very vocally his position on some of the provisions, and we'll see if we can't make some modifications and make sure that this works for our members and your clients. Thanks so much.
Bye-bye.